All right, let's get right into it. Welcome to today's Explainer, where we are unpacking a true corporate titan, Mitsubishi Corporation. Headquartered over in Tokyo, this is an integrated business enterprise that operates on an absolutely massive global scale. But what's truly fascinating right now, and why we're talking about them today, is their explosive recent market performance and the really bold moves they're making to secure their future. We're going to unpack all of that using data straight from the source.
Just a quick bit of housekeeping before we jump into the numbers. Please remember, this explainer is strictly for informational and educational purposes only. It doesn't constitute financial advice, investment recommendations, or an offer to buy or sell any securities. All the data we're looking at is based on publicly available info as of August 2026. Always do your own research before making any investment decisions. Okay, let's go.
So the sheer scale we are dealing with here is just staggering. Mitsubishi Corporation boasts a market capitalization of roughly 17.8 trillion yen. That is a massive footprint. But you know what's even more impressive? The stock has delivered a wild 57% return over the past year. I mean, that kind of movement for a company of this size, it absolutely demands our attention. So what exactly is driving this growth?
To answer that, here's our roadmap for today. We'll start with 1, the energy transformation, followed by 2, the Q1 financial breakdown. Then 3, strategic diversification pursuits. After that, we'll look at 4, the Wall Street consensus, and wrap it all up with 5, risks and challenges.
Starting right off with Section 1, the energy transformation, specifically the U.S. shale gas megadeal.
So even though CEO Katsuya Nakanishi has Mitsubishi operating across 8 totally different business segments, energy has undeniably become the primary engine of their recent growth. And this brings us to what we're calling the big bet, $7.53 billion. That represents Mitsubishi's historic acquisition of Aethon Energy Management's Haynesville shale assets down in Texas and Louisiana. To break that down, it's $5.2 billion in equity, plus they're taking on about $2.33 billion in assumed debt. Make no mistake, this is a major structural shift for the whole company.
And guys, they moved at lightning speed to lock this thing down. The timeline is crazy. They announced this acquisition on January 16, 2026. Fast forward to July 14th, the deal was totally closed, and they'd already spun up a brand new, wholly owned subsidiary called Adamas Energy to run the operations, with Gordon Huddleston stepping in as CEO. By Q1 of their fiscal year 2027, the financial integration was completely done.
And this integrated process shows exactly why they were in such a rush. Mitsubishi didn't just buy a gas well, right? They bought the whole shebang, an entire integrated value chain. It starts with upstream gas extraction in the Haynesville Formation, pumping out 2.1 billion cubic feet per day. That flows through domestic pipelines straight to LNG export terminals, which equals about 15 million tons per year. But step 4? That is the real game changer here, AI power generation. Mitsubishi is positioning itself perfectly to feed the absolutely surging, massive power demands of AI data centers all over the world. And Wall Street is definitely picking up on this strategic brilliance. Macquarie actually upgraded Mitsubishi to an outperform rating, directly citing this setup. This upgrade really points to 2 massive global trends right now: tighter global gas markets, which obviously boost the bottom line, and the urgent need for strategic energy security. Look, with the ongoing Iran war and broader geopolitical tensions disrupting traditional Middle Eastern energy routes, securing domestic U.S. natural gas has literally become a vital asset for Japan's overall energy security.
Moving on to Section 2, Q1 financial breakdown. Let's see how they're validating the strategy.
Because a killer strategy on paper is great, but does the math actually back it up? Well, take a look at 298.5 billion yen. That is Mitsubishi's consolidated net income for Q1 of fiscal year 2027. The crazy part, that represents a 47% increase year over year. Analysts were estimating they'd hit around 247.58 billion. Mitsubishi just crushed those estimates, completely proving that this energy-focused strategy is paying off immediately. And the top-line revenue beat was just as wild. For Q1 net sales, the analyst projection was 4.32 trillion yen. The actual result they delivered? 5.18 trillion yen. That's a 23% year-over-year growth in pure sales alone. Plus, if we look under the hood, the underlying operating cash flow for the quarter hit a ridiculously robust 341.2 billion yen. They are just generating massive amounts of cash right now.
Riding that incredible wave of momentum, Mitsubishi decided to maintain its full-year net income outlook at 1.10 trillion yen.
So despite all the global market volatility we're seeing, they are still projecting a 37% year-over-year increase for the full year, and that's being driven heavily by this newly integrated U.S. shale asset and their ongoing LNG operations.
But here's where this story goes from a simple energy play to something much more compelling. It's a classic balancing act. On one hand, we have the big bet. That's the traditional energy, U.S. shale, and LNG that is generating all this immediate heavy cash flow. But Mitsubishi knows the world is shifting, right? So on the other hand, we have the hedge. They're literally taking those massive profits from traditional energy and actively funneling them into future-focused tech like space exploration, decarbonization, and healthcare.
Which brings us to Section 3, Strategic Diversification Pursuits, Securing the Future.
So how exactly is this corporate giant securing its future beyond fossil fuels? You've got to see the sheer variety of these investments. First up, Carbon Neutrality 2.0, which they announced on May 1st. They've completely reset their 2030 target, now aiming to achieve a 30 to 50% reduction in greenhouse gas emissions compared to 2020 levels. Next, on August 7th, they expanded their strategic alliance with Medipol Holdings, deepening a healthcare partnership they've had for 2 decades. But honestly, the most fascinating hedge, January 13th, an investment in Starlab Space LLC. Mitsubishi actually acquired usage rights to an experimental commercial space module. They're securing a future for next-generation semiconductor manufacturing and even cancer research up in low-gravity environments. No way, right? It's like something out of a sci-fi movie.
Let's shift gears to Section 4, Wall Street Consensus, the Analyst's Verdict.
So, we've gone through the strategy, the huge financials, and the future hedging. But what do the actual financial professionals think of this entire package? Well, according to the 14 analysts polled by S&P Global, the sentiment is overwhelmingly positive. The consensus is split right down the middle between buy and hold. And I really want to emphasize this loud and clear. Out of those major analysts polled, there are absolutely 0 sell recommendations on this stock. 0.
When you break down their 12-month price targets, the average target is sitting at 5,381 yen, which implies about a 10.7% upside from where we are currently. The absolute high target reaches all the way up to 7,000 yen. Looking at the specific firms involved, Mizuho, Tokai Tokyo, and Daiwa are out there with aggressive buy ratings. On the flip side, JP Morgan, UBS, and Nomura are holding more cautious hold positions, mostly just acknowledging the stock has already had a massive run-up recently.
Finally, we arrive at Section 5, Risks and Challenges, Navigating the Headwinds. Look, no analysis is completely objective without steel-manning the potential pitfalls, right? We have to look at the bear case. So here's a stark look at the 5 critical risks that could easily disrupt their momentum. First, valuation. The stock is currently trading at a price-to-earnings ratio above 20 after that insane 104% return over the past year. It's not cheap. Second, geopolitics. The uncertain global environment, especially the Iran war and broader Middle East tensions, presents very real supply chain and market risks. Third, assumed debt. Swallowing that $2.33 billion in debt from the Aethon deal is a pretty heavy load to carry. Fourth, execution risk. Integrating a massive U.S. shale operation is incredibly complex. They still have to prove they can hit their projected 60 billion yen profit increase from this specific business unit. And finally, lagging ROE. Their return on equity recently declined to 8.5%, and that is still well below their own corporate strategy target of 12% or more.
Which leaves us with one big lingering question. Currently trading at a roughly 19% discount from its 52-week high, can Mitsubishi successfully execute this staggering 1.1 trillion yen profit vision amidst such complex global volatility? I mean, they've made the big bet on traditional energy, and they've definitely placed their hedges on the future. The data is incredibly strong, but as we just saw, the risks are very real. I highly encourage you to use this explainer as a jumping-off point to do your own deeper dive into this fascinating corporate giant. Thank you so much for learning with me today, and keep exploring.